Hi, dreamers. What a wild ride we've had so far in this administration. And you might be seeing a lot of investors who are going to cash instead of investing in this volatile market. So, what do I think about going to cash? And how much cash am I holding at this point as an income investor? So, let's talk about it. The pros and cons of going to cash. And if you do, where to hold all that cash. Are you ready for another topic with your very own dream girl? Alright, so unless you've been living under a rock, you're aware that Warren B is holding on to a mountain of cash. And just in case you're not aware, that pile of cash amounts to about $300 billion. Now, where did that money come from? It came from a big sell-off of his shares of Apple and Bank of America. And although he has added some stocks in the recent past, like Ulta Beauty, from what we can tell, he's hanging on to his cash because according to him, the valuations in the stock market have become way too inflated. And he includes Berkshire Hathaway in that, by the way. Now, just because Warren B is holding on to cash doesn't mean you should necessarily go to cash, because we all know he's the king of rotation. And so this is something he does every few years as he's reading the tea leaves. And I don't claim to be a Warren B by any stretch. But what does start to give me pause are all of the analysts from the big banks and brokerages starting to come forward and saying things like, the S&P probably not going to be the best place to invest in 2025. Gosh, that is a stunning statement. And over the past few months, you've probably noticed I've been very consistent with my predictions and concerns. And even though I'm generally a more defensive investor, I've become even more defensive. And the reasons are as follows. First of all, you have to give me some credit, because politically I'm more of a centrist, who's not a fan of certain candidates. But even so, I kept all of my money in the market past the election with the best of hopes. But I think we've all seen that this administration is not only going to be unpredictable, but unreliable. And that's caused me, and frankly all of the investors, to reassess what level of risk there is in the American market and economy itself with this leadership. And if you've been following me for a while, you probably know a couple of things. One is that pre-COVID, in the last time this administration was in office, I actually withdrew 100% of my investments based on how they were running things. And so when the COVID crash happened, I was 100% in cash. Can you believe it? And thus was able to write it up a bit on the return. But another thing that's new this time is that I've been feeling the pressure of, frankly, this YouTube channel to keep fully invested and keep my graphs going ever higher. But I think also, if you know me well enough, you know that this channel really wasn't meant to sway you one way or another, or even collect me any accolades. Because at the end of the day, dreamers, I'm just a woman out here on my own with no safety net other than myself. And it's been a long, hard road to get here. And so I've had to take a fresh look at this and determine what risk profile I'm willing to accept. And if the benefits of collecting the income during this next short-term time frame outweighs the benefits of retaining the principal amount. And I'll add one more thing, that there's something to be said for if you've already won the game and you have enough money to last the rest of your life, what would be the reason to put it at risk if you suddenly realize the risks have increased substantially in the short term? And so for all of those reasons, I used to be running very lean with only a few $100s in my checking account, relying on all of that dividend, interest, and options income to fund my lifestyle every single month. But over the last month, with every pop in the market, I started taking some cash and spreading it across accounts for safety. So let me tell you what I've done. So the cardinal sin of any income investor is pulling the principal out, because the main goal of being a dividend and income investor is that you can let your investments go up and down while the income continues to cover your bills. But given the severity of the unreliability and the significance of the risk increase, I have decided to go max defense. And here's what that looks like for me. On the options side, I've stopped doing puts and started just doing covered calls because that is a more bearish stance. But it will also reduce my options income quite a bit. In terms of the dividends, I've sold off some of my growth positions, but certainly kept my positions in staples, utilities, and the broad-base derivative funds like JEPQ and SPY-I, and the Goldman Sachs products. I've taken a chunk of money that is enough to pay off my entire house and moved it completely out to another brokerage, which is reminiscent of what I actually used to do, where I had a totally separate brokerage set up just for my house and house funding. And so like I covered in the last video, I've spread across brokerages in order to maximize the SIPC insurance in case of the unthinkable liquidity event, which hopefully we will never experience. I've also taken a significant amount of money, about $400,000, and put it into general money market accounts and treasury funds. And this is cash I'm just going to hold to the side until I feel the market has calmed down a little bit, or if, well, hopefully not, we have a significant event that impacts wealth, in which case I would reevaluate. But until that time, I have that level of money in things like SPAXX, just the general Fidelity Government Money Market Fund, which you can see is in U.S. Treasury, bills and coupons, and also government repurchase agreements. I've also parked some of that money in SGov, which is the iShares short-term Treasury bond ETF. This is an ETF that doesn't really move in terms of the price, so it won't go up, but it also won't go down. And here you're going to get a rate that's about 4.2 with an expense ratio of 0.09. And there's also a Vanguard lookalike, which is called VBIL, which is essentially the same thing, and just a little bit cheaper with an expense ratio of 0.07, but also right around that 4.2 yield. So with all of that said, what is my plan? Well, this is really not about waiting to buy a dip, but for me, it's more about a security move. So what's my plan with this? Well, my plan is to let my invested staples and utilities and broad income funds continue to reinvest and compound over the time frame. But for the cash reserves, my plan is to simply wait until the risk goes down. And dreamers, that could take 1, 2, or 3 years. We're just gonna have to wait and see. And while I wait, I'll be sleeping a lot better at night, that's for sure. When will I know the risk has gone away or gone down? Well, when I start to see data turning around in a different direction. Because right now I'm seeing things like tourism starting to slow, housing starts starting to slow, and consumer confidence pretty low. And I know all of the logistics and tariff stuff is going to take quite a bit of time to work out. And while we're in the middle of this, since this is the core philosophy, we're going to have some tough times ahead as everyone struggles through it. And so what should you be thinking right now? Well, here's what I have been thinking. First of all, assess the liquid needs of your next 1 to 3 years and make sure that you feel comfortable that if you have a big purchase ahead of you, or maybe even a retirement schedule ahead of you, that you feel confident you have enough cash available to you to make any kind of big purchases that you're going to need. The next thing I would do if I were you is maybe sort your entire profile, maybe based on current value, to see your top 10 positions, and then think about the risk versus reward of those top positions. How likely are you to preserve that principal over the next 1 to 3 years based on some of the changes that you're starting to see out there? And the next thing that I might start thinking about is how broad and diversified I am. And when I start thinking about broad, I'm thinking about holding the entire S&P, the entire NASDAQ, or maybe even owning some international indices. And you know I like to hold those broad indices that also have a hedge in there with the derivative income on top. And the last thing I would say is, just because you might set some cash aside doesn't mean you necessarily have to pull the ripcord and go 100% to cash. Just remember, my reason for doing this is really not to time the market, but rather to feel a little more comfortable with my risk profile across my entire portfolio and make sure I've got growth, I've got income generators, and then I've got a percentage of my portfolio that's just focused on wealth preservation in this riskier time frame. So I hope that's helpful for you as you think about balancing the needs of income and the risk in the next 1 to 3 years? I'd love to know what you think and what you're doing in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.